Hello. Hi, welcome.
Hi guys, welcome.
Hello. Okay, so welcome to the Prima Huddle. We're just a few minutes away from getting started. So if you can just, allow us some time to get the rest of the people in, that would be great. We'll be starting shortly. In the meantime, if you are familiar with Prima, our dynamic huddles, you would know to, rename yourself just to familiarize. We would love to know who you are, where you're from. So I've noticed Edo from Philippines has done it already. Thank you very much. And if the rest of us can follow, hi Eileen as well. Thank you for joining. So if you are new to Prima Dynamic Huddles, we like to start off our call with being able to rename ourselves. So if you like to just go to your profile picture, click on it and type and click on the rename function. We would love to know who are you by your first name, comma, where you're from. You can try and be creative, you can try and be funny. We just want to know who you are really. So welcome to Devesh, welcome to 110100079. Yes. As we wait for more people, we hope that you can get a little bit comfortable, turn on your videos if you'd like, and just please use the chat function freely. We really appreciate any input and your interaction here. Okay, I think we should give ourselves a little bit more time. We're about 15 people in. Hi everyone. Welcome to Prima. So part of what we're trying to do every single, what started off in very early this year was there was still an appetite from people in the risk industry sharing about best practices, especially during this uncertain times. What are people around the world doing, given that we have this shared experience globally? And so what started out as a sharing platform exclusively for corporate risk managers has now turned into a weekly kind of a huddle where we talk about topics from anything from how was the Diamond Princess cruise disinfected to all the way to, how is resilience, how are we going to tackle resilience, mental resilience among employees when we come back to work, to now to talk about Insurtech and what does this mean in the post-COVID-19 environment. So I think it's great to see a spectrum of topics, and that's really what the Prima Dynamic Huddle stands for. It's only 45 minutes, so we don't hold back a lot of people's time, but we like to do this at the start of the week, so thank you all for joining us. We have a really exciting panel coming up. I hope in terms of, addressing the question of, is tech a game changer or just, an efficiency facilitator in the insurance industry? And especially, what does it mean now after this whole crisis that we're going through? So very excited to have a whole panel, but I would like to bring in our moderator. And before I do that, I'd like to encourage all our participants. I'm sure by now all of us know how to use Zoom, but if you can, please rename yourself with your first name, comma, where you're from. We would love to know who you are, where you're from. And just to get us a little started, please feel free to chat on the Zoom chat. Please ask any questions. We would take any questions anytime during the session. So please use that chat function freely and please use it freely. And also we will be doing a series of polls during this session as well. So if you could, maybe what we can do is also start off by doing a little check-in. So how is everybody feeling today? And just a way as to get everybody, in the mood on just do a check-in before our session. So if you would like to answer, how are you feeling and where are you working from today? And then what we'll do is we'll bring out that results so far. Sam, if you could. to just show us what's going on. Great. So happy to know that we have a bunch of happy and optimistic people today, which is great for our open-minded conversation. And where are you working from today? The real office, home office, doesn't really matter anymore. So thanks everyone for your upbeatness. And let's just get started. So Farah, who is the CEO of Level 1 IBFC, would you like to take us away?
Thank you, Stacey, and good afternoon, evening, morning, shiny, happy people. Thank you for joining us today. I have an amazing panel of very diverse gentlemen today. I'm sure everyone here knows Steve, our Secretary General of Parima. George represents the Insurtech Association of Asia. And we have Jack. Jack is the chief officer of Igloo, which actually is an Insurtech based out of Singapore. So I'm based out of KL, in KL at the moment, and all three gentlemen are in Singapore. We're really excited today to talk about Insurtech. I mean, it's something that maybe risk managers understand quite well, but because of COVID, what has happened is that it's fast-tracked the requirement for technology. I mean, we're all here using a technological platform that has basically taken over the world, called Zoom. There's no reason why the insurance industry, the risk management industry cannot adopt it, cannot adopt tech a little bit more. So that's the basis of our conversation today, and really to try and understand, is there a relationship that can be forged between Insurtech and corporate risk managers, and how we can move forward? In preparation for this huddle, I did a bit of work and found out that the CAS Business School recently launched a research report that talks about how COVID is actually a huge catalyst for the adoption of digital techniques, digital platforms across all segments of insurance, and has really highlighted the value of having a dynamic risk manager, and that having that dynamic risk manager adopt technology. So it's a very interesting way to start the conversation, I guess. Steve has put up a link to that piece of work, and it's cascityhere.ac.uk. It's interesting in the sense that it talks really about not only the role of Insurtech, it talks about the role of risk managers, vis-a-vis COVID, vis-a-vis insurance, vis-a-vis tech. And really, it shines new light as to the possible strategic role risk managers should play in large organizations. But first, I wanted to thank my panelists for agreeing to spend a little bit of their afternoon with me and us all. And I wanted to kickstart the discussion by really talking about why hasn't Insurtech taken off or gained traction as much as we'd expect in the wholesale market, in the corporate market, as it were, vis-a-vis the more retail market. And I open it to our panel. We really want to have a very interactive discussion. And also, if you have any questions, just key into the chat box, and we can take the questions as they come. And any of the panelists, I'm quite happy for you to also pop up a question if you're interested in asking any of your other fellow panelists a question, and we'll take it as that, like just a chat among some peers. Yeah. George or Steve, would you like to take the first question? Why hasn't it taken off the way we expect it to?
Go on, George. I mean, you gave some good examples in the warm-up, so that was interesting. So if you share that, that'd be great.
Okay. So as far as I can see, in terms of the risk management adoption of the Insurtech technologies, I guess the risks that themselves are very complex, and therefore as an Insurtech technology right now have gone through very simple commoditized risks and is starting to go into more of our data-driven products. I think this is one of the reasons why we haven't seen as much of a technology being applied to this complex risks, the risks that really the risk managers look on a day in, day out basis. And what we're also seeing is that because those are much more craft-oriented business risks, it hasn't really been a lot of data that has been available for the Insurtech to really power up on it. I think that's kind of the key components to me why it hasn't really taken off yet. It is not to say that it's not something that will change, will not change. In fact, I believe that there's a tremendous opportunity for the technology to come in and augment what is being done in this segment.
George, Steve, what do you think of that?
I think that's correct. So there's I mean, broadly speaking, if you take relatively straightforward insurance products for personal lines, life insurance, and SME products in the main, you tend to have, roughly speaking, 80% is fairly homogenized, fairly similar, and 20% is unique or different or has to be highly bespoke. Whereas I think for risk managers working in big corporates, it's fairly safe to say the reverse is true. That only 20% is standard and the rest is very bespoke. And that bespoking changes every year. I mean, this year, most risk managers are seeing dramatic changes in the way they're placing things because of the hardening market, because of COVID, because of so many other factors this year. It's definitely not business as usual. And I think, you know, coupled with that feeling of uniqueness, and I'm not saying it's definitely it is a feeling. It's not something where we have uniqueness in reality, in my belief. But coupled with that also is you've got a historical position where this is very much a person-to-person business, and that is going to take a long time to move. I think there's a lot of education for multiple parties here because it's a three-party experience. There's education for the risk manager. The risk manager is comfortable with the idea of picking up the phone to a broker and saying, I don't want it blue, I want it pink. Thank you very much. And it just happens. So on that side, there's not necessarily reluctance to move to technology, but there's a reluctance to take on a lot more work in terms of data inputting, et cetera, if that has to be manual. I think the brokers themselves, most of the guys in the broking companies, you know, with due respect, there's an increasing number of millennials there, but it's increasing from a comparatively low base. So there's a lot of guys in the broking businesses who've been in different ways of doing business all their life, and again, it's that relationships thing is what they know as well. So they're not exactly rushing back to risk managers and saying, hey, let's do everything on a tech platform from now on, because they don't see that as in their personal interests either. And then, quite frankly, most of the insurers in this space are exceptionally slow as well. If they're spending money on technology, they're spending it on personal lines, they're spending it on life. They're not really spending that much on marine cargo or political risk insurance. They are, it tends to be internal rather than external. So there's a lot of potential barriers there, and we can dig into some of the details of that as we go through. But there's a mountain to climb.
There is, and I think to start this climb, as it were, it might be helpful to look at the risk itself, like profile the risk itself. So you've got bespoke wholesale risk, you've got private retail commoditized risk. And so, you know, as George was saying, a lot of what's happening in the Insurtech business is retail stuff. And it's easier, in a way, with all due respect, to manage Insurtech in the retail space because there's data. There's data and there's a need for tech in the sense that the tech facilitates distribution, it facilitates crunching, it facilitates expansion. So in a way, it's a natural fit. They both need each other in a way. But when it comes to bespoke risks, then it you know, all the challenges that Steve spoke about, that kind of kicks in very quickly. And then you've got strategic risk and operational risk. So, you know, risk is not just risk, it's different types of risk, and different type of risk will then be prone or less prone to Insurtech depending on where they stand or where it sits. But regardless, right, of what kind of risk, there is this perennial issue of information. You know, and information is something that I was listening to the COVID brief by WHO. So the chief pandemic officer said, information is key to make the correct risk-based decisions. And he was talking about personal risk-based decisions vis-a-vis COVID. And, you know, will you fly? Will you go to the mall? Will you watch a movie? In KL, we can watch movies now. Would you do that? I had a girlfriend call me to do a spa party, and I was like, personal risk decision again. But that's based on information. So do you think, does the panel think that when it comes to bespoke wholesale risk, where a lot of our managers deal with, which is what they deal with on a day-to-day basis, do you think as it stands today, there's enough information to even create a base so digitization can happen, you know? And I know this is a question that we didn't agree on before, but I thought it'd be an interesting idea to start talking about the quality of information in order to make that risk-based decision.
It feels naturally that there's information there because that's what the insurers and the brokers are using to facilitate the risk transfer. But the information is very much locked in the silos. And a lot of it is also not only locked in the silos as it's for this year, but is also a historical information that is sitting kind of in a gut feeling of a person or in the mind of somebody else based on a historical experience. And that's the real big challenge for the technology to come in, because you need to come in to create the foundation for the technology to really drive it. With no information available to kind of seed it, it is very much a challenge to start. What we've seen that's been interesting is that usually, even with a lack of information, technology will find that initial crack in the armor per se, and it will pick the area that is most prone. So that's why the usual kind of disruption or things will start with a very small type of risks or more of a commoditized type of risks, and they will progress from there as it kind of starts to build that base. In the beginning, it becomes like a kind of a by the way experiment, but very gradually it starts to incorporate all the other data and grows to a point where the data is comprehensive enough to be able to even assist in the high end of the spectrum. So it's kind of like gradual evolution there.
Yeah, so, and I also want to adjust here. So I also want to add a bit from the more insurance actuarial background. So actually this thing exactly happened in the insurance actuarial world, where a lot of insurers in the country finally agree to share their claim data together to ultimately reach like a mortality table or claim table of that country or that region. And there were some interesting innovations on how they share the data and doesn't reveal the actual claim rates. So I guess this really requires some association or some big players to lead the game and use some technologies to drive this data sharing to benefit everyone. So I would say that's something that blockchain can play, where there you have this distributed trust among the players.
Jack, that's very, very interesting. Where have you seen that happening, and which countries and which lines of business are the actuaries pooling their data together?
Yeah, so basically, usually every country, the societies and the regulators pool the mortality rates from, at least the mortality rate from the insurers to build up a table. And so they will share this table with all the members.
Yeah, but which countries, Jack? Do you know which countries?
I think most countries do this. I think most countries do this. Singapore government also pull some data. I think China, US, all the big countries do something similar.
Right. But specifically in life insurance, yeah?
Yeah, it's more life insurance because, I mean, death is kind of standards across everywhere.
Yeah, it's fairly clear when you've got a claim, that's for sure.
Yeah. I mean, there's not a lot of disputes there, I suspect. But yeah, it's quite interesting. So what you're saying, so correct me if I'm wrong, Jack, but what you're saying is that even in a more retail environment, which is life, there is data pooling, but still that quality of that data could be better.
The quality of data could be better when you kind of understand what's your risk compared to others.
Yeah.
No, because you understand your own marketing strategy, you understand your own targeting strategy. So then you get data from others. You kind of try to evaluate how should you address your own strategy, and how is your risk against the overall market. Yeah.
No, that's true. That's true. It's quite interesting to think that even in the retail segment there are challenges, I guess. And what else in the wholesale space? Steve, do you have something to say about data, information, and the lack of?
Well, I think it's interesting, and I want to ask Jack to comment some more on some things, because it's, you know, I mean, it's a pretty good example. Life is life. It's pretty well, yeah. I mean, the base data you're dealing with is fairly common in many respects, but you take that to the other extreme in a commercial portfolio. Perhaps they've got 50 properties. Perhaps they're in 30 countries. Some of them are factories. Some of them are office blocks. So the granular data is there, but it's how do you build that up into a broader portfolio? That's going to be the challenge in terms of the diversity of data in some of these pools. And I think what I'd like to sort of ask you, Jack, is where do you see that sort of commonality of approach coming next? I mean, you're not just doing live stuff; you do all sorts of lines in your company, don't you?
Yeah. Right.
Into some other areas as well.
I would say in the more Insurtech space is everybody trying to build an index for something, right? For example, you want to have properties across different places and so on, but you try to build an index of that property based on their location and probably age or something. I would say a better example is more on the more climate change side, I would say. People are building climate change like a temperature index, where they can kind of relate their risk of floods or storm or hurricane or agriculture like kind of index. Or they all relate all these different scenarios to a single temperature index and calculate the correlations. So they can kind of hedge the risk to some extent. Of course, so all the players can use the index as a benchmark, then calculate the correlation between their risk and this common index to some extent to evaluate the risk.
Yeah, that's how I guess the natural catastrophe modeling in most parts of and I can see, I'm not going to draw him into the conversation if he doesn't want to, but I can see Vengs here from Swiss Re on the, I can see a Veng, that's why I mentioned it. But yeah, that modeling is generally considered to be a proprietary element of underwriting process in each of the big companies at the moment. And I'm not sure what the trigger would be then to open that up so that there's a broader understanding of that across the market. And I'm not even sure there's any driver to do that. I'm not sure what would drive that to happen, if you know what I mean.
Yeah.
You know, it's interesting to think that at the end of the day, it's about information and relationships. The two things that technology cannot do: have a relationship and have information, right? Which is the core, really, of what insurance is about in that sense. And especially when you look at wholesale insurance. So first and foremost, you know, for me anyway, and I don't know whether, you know, the panel agrees, but it's also the issue of relationship with brokers. And you talk about Veng and, you know, Swiss Re and a lot of other brokers that might be listening in. It's about that relationship, that important relationship that brokers have with their clients, and that the sanctity of information. So when you're looking at an individual that's part of a retail program or sharing information and stuff like that, it just seems a lot more accessible. When you're looking at a multinational company with huge competing issues, competitor issues, they're not going to be able to share that information. So, you know, could that be the core reason why there is a delay in adoption or maybe not even a resistance, but kind of a delay in adoption? And could we maybe see a middle ground when we start looking at the broker-client relationship and the importance of Insurtech when it comes to crunching information? So is there like a middle ground, as it were? Do you think we can? Do you ever think we can come to this middle ground?
Well, I definitely do. I mean, I think if you look at the types of insurance that companies, as big customers buy, they don't just buy big, lumpy, complex stuff. They buy pretty simple stuff as well. So they buy travel insurance, or they buy, comparatively straightforward employee benefit policies. They buy some complicated ones as well. They buy motor insurance. They buy these sorts of other lines that are comparatively commoditized already in the personal line space. So there's a reason why over time those companies can't get more comfortable with doing basically the same in the office as they do at home. It's just it's getting used to it. I mean, it's the old thing about why does every company have a bring your own device policy? It's because the CEOs of most of those companies said, I don't really care what you say in your policy, I'm using my iPhone. And therefore, after that point forward, companies had to have a BYOD policy. And it's a similar sort of thing. If there was if you've got a risk manager sitting there and he's compared prices for car insurance online, and knows he can get exactly what he needs by running a few permutations, then it's not that difficult a step to move from saying, well, instead of buying it for one car, I'm now going to buy it for 100 Toyota Corollas instead. The interesting part of that conversation is, will you realize the same economies of scale? Will you do the same service if that all goes spectacularly wrong? If you're just an individual and you have a car crash, you can spend all day running around getting money in. But if you've had 20 cars lost in a fire, the last thing you want to be doing is spending 20 days trying to get that money back in from all the individual claims. So there's scaling issues, there's economies of scale issues, but in principle, many of those things are, I see that as the sort of the pointy bit of the wedge. How far the wedge goes, of course, is a different issue and could take a lot longer.
Yeah. George, do you have something to say to that?
Yeah, I have a little story to share. So the last week I was talking to one of my friends who works at Google, and they do, aside from working at Google, they also do investments in a lot of startups. They call themselves Zoogler Angels. And I asked him this very question. I said, what do you think as an outsider to the insurance about the insurance brokers? Do you think they will always be there? Do you think that it is going to change? And his input was very interesting because he said that he's drawing parallels to other industries. And what he's seeing is, for example, property agents right now are going through the same process where, let's say in States and even in Singapore, there are startups that are coming in and are almost like reversing the role of a property agent. So property agent used to be the one that's doing marketing the property, doing all the showings and doing all the logistics. But the platforms are coming in to take a majority of that and automate it away. And the property agent is still there, but it's very much at the back of it, doing the servicing, doing the final sales bits. But technology, are the ones, the platform, the startups are the ones that are employing this agents. So he said that he sees a very similar process that's going to happen for business insurance, and the role that the broker is playing for it as well. Because the personal element, and like what Steve was saying earlier, that service element is definitely an important component. And I don't think this is going away anytime soon. But a lot of it is going to be all about automation, making things a lot simpler. If you're buying a property insurance, whether you insure in a building or a store, it's starting to become more of a commoditized lines of business insurance. And this is where I think the technology will come in and start to really displace the need for somebody to, pass the emails, arrange the quotes, and kind of all this back and forth that's happening right now.
Yeah, no, absolutely. I mean, speaking as an ex-stockbroker, I can tell you that all those years ago when internet broking first came about, yes, I'm that old, everyone was worried. All the remisiers were worried. Everyone was concerned that they were going to lose their jobs. And guess what? They haven't. Because you can't replace the human touch. You can't replace that knowledge and that relationship. But there has to be a middle ground where technology kind of facilitates it, and then the human kind of moves it forward. So yeah, I absolutely agree. The parallel with other industries is something important that maybe the brokers can take away. And the risk managers then can look at it and say, well, if this is going to be the case, then maybe I could reduce the cost of buying insurance as well, but we'll see. But do you think that, something as massive as this pandemic that we're all experiencing at the moment, do you not think that something like COVID is enough to push the industry to that next stage of adoption?
Well, it depends what you mean by the industry, because it's very big and messy. And
well, yes. Well, the managers to start looking at it, or the brokers to start adopting it, because they're two bits here, right? One's the broker and one's the manager. So do you not think that something like COVID would be enough to kind of push forward the Insurtech proposition, as it were?
Well, I think to put that the other way around, this is a bit of a baptism of fire for many risk managers we're going through at the moment. I mean, broadly speaking, if you'd asked me this question last time, this time last year, I'd have said, yeah, we're coming to the time. The market was beginning to harden, and for many risk managers this time last year, facing a hard market for the first time, perhaps in their careers, for some of the younger risk managers, that's quite a traumatic experience. Now layered on top of that, we've got COVID, and COVID is making markets even harder, more difficult. I mean, there's plenty of anecdotal experiences around. I mean, I've recently been involved in a placement of a trade credit policy. The premium on that last year was 1.5 million US. The premium asked by the incumbent this year is 8 million. So 8 million. So that's gone up. Oh dear, it's gone up. So
not really.
What are you going to do as a risk manager? You can't just rely on, in previous years, you might have been able to go back to your CFO and say, don't worry, I've saved you 10%. I've hit my KPIs. Let's move on. So there's no drive there to use technology. There's no drive to do anything, because you just need to keep banging the drum in the same way. But this year, I think we're seeing a lot more pressure. There's going to be a lot more questions asked, and people are looking to be more creative. Now, whether that's through captive insurance, whether that's through retention of the risk, whether that's through technology, I think only time will tell. And we'll see all of those things coming more to the fore. But I think the technology one is tricky, because the risk manager can't do that in isolation. It really depends on the whole of the industry to give the risk manager that as a meaningful option. And for the risk managers in big companies, that doesn't seem to be quite there yet, if that makes sense.
Absolutely. Any comments from the other panelists?
Yeah, so I think as far as I can see, the catalyst for the change is coming. And every time when we see the pain is really where the opportunities are rising.
Yes.
When things are comfortable, where everybody, like what Steve was saying, like at 10% savings year on year, there's really not a lot of drive for change. Everybody just continues and say, like, let's keep things status quo. What is also very apparent is that during this period where there's a lot of social distancing, where people cannot meet face to face, the brokers are also discovering that their methods of operating and meeting their clients is being quote unquote disrupted, and continue doing things as the way they have been is no longer sustainable.
Correct.
So it is kind of hard to see exactly which way it's going to go. It's like this period of unpredictable. It can go left, it can go right. But as long as we basically all recognize that you just cannot continue going straight.
Yeah. Yeah, no, that's very true. Jack, do you have a comment on that, or failing which I have a question for you?
Oh, really? Maybe you start with your question first.
Okay, are you sure?
Yeah.
It's not going to be pleasant. The counter to all this adoption to tech is the fact that some people say tech just costs too much to adopt. Will tech actually increase the cost of risk?
Actually,
of managing risk?
To some extent, it's true. I would say even for some insurtechs who promote themselves as like the insurtech machine learning and so on. So, I mean, technology can help you to understand the risk better. But suppose you have a portfolio and someone claims they can do a dynamic premium or risk analysis on the portfolio. But overall, the end result should be the same, with or without a model. Anyway, it's a lot of large numbers that determines what's the average premium you should charge. So, I mean, if someone just introduces you a dynamic premium, some fancy technology, it doesn't really change your average premium, and it's a cost to you. So the entry point for any insurtech or any new players is how to improve the process and introduce efficiencies to the process. Probably I can't really change the premium. I can't really change the premium claims, but I can make the process much faster. Whatever took like 3 to 5 days, I can get it done within 1 day. Okay. And maybe some customer will pay some extra premium for that. And once the insurtech or the new player comes in the game, then the player will understand the risk better, understand the process better, and improve efficiencies. So actually, that's what we're trying to do now. I mean, try to build a ready-to-use solution for clients. I mean, partners or insurers. Start with something small, improve the process, and slowly get the knowledge to improve the everything and bring more efficiencies into the industry.
Okay, that's a very candid answer. Thank you for that.
Yeah.
George, Steve, do you think tech is going to make it more expensive, at least in the beginning anyway?
I think that it maybe is a slightly different way of thinking about it, because tech, while adding the layer of cost that was not there before, is inherently more aligned with the risk managers being the client than, let's say, the traditional method. Again, you're coming back to the comment that Steve made before, when the premium, let's say, goes from $1 million to $10 million, the person that's not complaining, or the party that's not complaining about it, is a broker, because the broker is making significantly more revenue as a percentage of commission that they're earning from it. So there's no incentive really on the broking partner to drive down that premium. But if the technology is coming in from a perspective of being employed by the risk manager as the end client, I think this is really where the opportunity can come in. And you can say, like, yeah, we're looking for savings. It's going to cost us $1 million in the first year, but I'm looking at, I'm looking at the subscription or technology cost that will deliver me this KPIs for subsequent years, right? I think that could be the real alignment. And if you create the business case based on that, to say, like, we're looking at shared savings, I think that inherently is something that, it's not going to happen in the first year break even, nor does most of the investments. But if we look at it from a standpoint of a multi-year investment, I think this positions it much better and kind of aligns it in a much better way than thinking about it as, let's keep the status quo. And especially in this environment where the premiums are going to be escalating, it's hard to market. I think this is something that definitely needs to be looked at closely.
Yeah, it makes sense.
Comment on that. I would note that I think probably quite a few risk managers would want to come back and say, well, actually, we don't just pay the brokers more. So in the case that I gave, for example, part of the negotiation was you don't get any more money than you got last year because you've actually done worse than you did last year. So So it can, that's normally on the risk manager's agenda to have that conversation as well. But you know, I don't want to be seen to be broker bashing, because they do bring benefits, and you know, and there's a couple of points in the chat about that, about, you know, what can, I mean, tech can't do some of these things. Tech can do the data crunching, but it can't help you to get a claim paid where there's a lot of ambiguity in the contract. And that, you know, with the right broker and the right support or the right consultant, whatever you want to use, that's how you get that sort of thing paid. So there's always going to be that sort of that role, which sort of comes back to what we were saying earlier. It's that whole you know, it's what you were saying about the brokers. I mean, again, it's showing my age. In the late 90s, there was something in London called the Big Bang of technology, and Marsh actually forecast back then that brokers were all going to die and that was the end of the world. Of course, it made no difference whatsoever, because the high level consulting service kicks in those problematic areas, and I think that's the bit where the real value comes. And as you say yourself, you know, you cast your mind back, and everybody used to be on the trading floors doing this, and of course you only see that in museums now, basically. So that whole part of it is going to change. The transactional stuff will definitely change, but to go back to the point on technology, I think you have to think very carefully about how and where the technology is applied, because technology for technology's sake is not really going to help. So to your point to Jack and my perception on this, you know, if I'm the customer, or I represent the customer, and I've got $100 I'm paying for my insurance, I've got a broad sense that, say, $20 is going to the broker and $80 is going to the industry, to the insurer, the reinsurer, etc. If someone sells me a new technology that costs $5, that's got to be paid for. So it's either paid for by the insurer or it's paid for by the broker. I'm now buying a policy for $105, which doesn't seem that desirable. So unless we find a way of changing the whole system so that instead of $100, that $5 means the spend overall is $85, then we're not getting that far. But that's a journey, because it takes some time to work out where those cost benefits are.
Yeah, absolutely, and also there's this, you know, I guess the simplest question would be this: when do you think, Jack, Igloo will start offering services to corporate buyers?
To corporate buyers,
because this is a business case, isn't it? It's really simple. At the end of the day, right? Your PE guys, the guys funding you in your Series A or pre-IPO, whatever it is that you're at, they're going to want to know when you're going to be able to scale up, right? In theory. And so do you foresee Igloo ever offering corporate Insurtech or technology solutions or platforms?
I would say to some extent, I would say the two sides of it, right? I mean, anyway, we are a tech company, and based on the current, I mean, AI or whatever technology is just, we're not there yet to replace a human. Anyway, I mean, all these algorithms requires tons of data for each specific scenarios. But anyway, probably even the whole industry don't have enough data to train a model to replace a human. So to me, to that extent, we're not there yet. I mean, we will not replace any broker in any near future.
Spoken like an actuary with all the inference to data and
yeah. But to some extent, right, I would say how we will play this, we will probably approach in two ways. One is really the pure platform and infrastructure way, where we build some systems to help the brokers to better share information more comfortably and more trust on the system. They can have more trust on the system, maybe by blockchain or some other ways. Maybe by blockchain or by some common index or some other ways. The other way is also try to commoditize the product. I mean, to some cases, it's still the end customer, like they're the policy, they're the coverage, but it's just packaged in some way that goes through a broker. So we will try to go to that kind of B2B to C kind of approach. But to address the question of does it cost more? I mean, ideally, our goal is to make a bigger cake for everyone. Although maybe you get $5 less on this policy, but you will benefit if we can help you sell double your revenue, to sell like double number of policies in next year. So then we can share the extra profit among the parties.
Yeah. So net everybody wins more, right?
Yeah. Net everybody wins more.
I have a question.
Yeah.
Sure, George. Yeah.
I have a question for Steve. And the question is, in terms of the data sharing, because again, coming back to that, I think it's a very critical component that is missing right now. Do you think that the risk managers are open to sharing data that maybe goes through the association or goes through some other entity that basically helps to see that new future of, you know, looking at the risk in a data-driven way? Because it looks like, yeah, one individual, let's say, organization that might have 5 buildings by itself is not interesting. But if you combine it and you say, like, you know, thousands of risk managers pool all their property data together, both in terms of here's my risk and in terms of my claims, this is really where it starts to get a lot more interesting. Do you think that that's ever going to happen, or do you think that risk managers are open for it?
Yeah, I don't see any problem with that at all. I think that'd be you know, again, get back to Jack's point. If we can find an appropriate blockchain solution that would anonymize that data and you know, make sure that we did the usual issues in terms of data privacy, data management, and compliance issues, then yeah, I think that'd be really interesting. There's good examples of that in other sectors, in other industries. I think it's a matter of time. But it will take some time. It will take some time to build a system and have a system that's confident, and people are confident in that. But I don't see why that would be a barrier to the sorts of things we're discussing.
Cool.
Thank you, panelists. I think we've had quite an extensive conversation, and clearly, like everything else in life, it's about coming to the middle, and it's about really, you know, finding something that works for both parties, the buyers and the brokers. Stacey, you're back and you're going to take over now. So thank you very much for spending some time with us this afternoon. I'll hand you over back to Stacey now.
Thank you, Farah. So thanks, everybody. Thanks the panelists, George, Jack, Steve, and Farah for your time. And obviously, you know, your very candid responses to these kind of very tough questions that the Insurtech industry and the has been experiencing for the last few years. I mean, George, you've been trying to get this off the ground. So we know how difficult it is, and how actually, even as risk managers, we also need to know about this, so that we can also find our own use cases and also be part of this conversation as well. So to everyone, I hope that this has been a insightful session. I hope you have took away something, or add on to something, something that you could bring to or think about. And I would just like to wish everybody, you know, to give us your feedback, and also do remember to join us in our upcoming sessions. So as we have said in the earlier when we started, Prima does do regular webinars, especially for COVID, for this situation right now. And we have a lot of trainings happening. We have a lot of things that's talking about BCP. We have a China-specific webinar coming up tomorrow. We have you know, trainings on certifications. We have things on cyber. We have things on loss adjustment. So to me, like, you know, please feel free to sign up for our sessions. And also, as you are looking at what we have coming up, do a survey on how you found this session today. As we go through our week, as this is the start of the week, I wish everybody stays safe, be healthy, and hope you have a meaningful and productive week ahead. So thank you, everyone, and thank you to our panelists. Thanks.
Thank you very much.
Yeah, thank you.
Bye-bye. Bye-bye.
Thanks. Bye.